All right, good evening, everybody, and I appreciate everybody being on the call. I appreciate your guys' time or being on the webinar. We've been doing these monthly for a couple of months, and I'm excited to see some of my friends and some of my already referral partners that we send business back and forth on, and appreciate your guys' time. So we're going to go through some things. You guys should have received a workbook through a PDF in your email that you got when you registered. My name is James Monroe. I'm a financial planner here with Oregon Pacific Financial Advisors. We're going to spend the next probably 35 to 45 minutes or so talking about basic overview of what we like to say the 6 steps to financial success. And we're going to cover a lot of information and give you guys the opportunity between each of the 6 sections to be able to ask questions. And if you guys want to put the questions in the chat, and Marlene is here to help me out with facilitating that. So between each section, if there are any questions that popped up, I'll do my best to answer them. And if I don't have an answer, if it's going to take a little bit longer, I'll just schedule a one-on-one call with each of you, and we can go through that. So welcome again, and thank you guys for joining us tonight for our seminar. A couple disclosures about our company and who we are and who we register our information through. So here's our workshop objectives tonight, is really to introduce different concepts, things like that. We want to give an education. Our goal here at Oregon Pacific really is to begin to have a bigger footprint and helping people with financial literacy. We'll illustrate a few things that may be pertinent to you or people that you know between different types of or different sections. Our commitment is to provide the just sound financial information. So one of the differences between us and somebody maybe at another company is that we are completely unbiased with the plans that we create. We have the ability to be able to shop the market completely independent from everything. And one of the things that we like to do when we help folks is to help them identify their goals. Then we're going to offer a complimentary consultation and a financial plan for everybody who joined us on this webinar and that was registered. So about your workbook, there's some informative graphics. I'll be referencing the page number in the workbook. If you have the PDF open, there's some stuff to kind of fill out for some information to try to figure out. But you know, in person, we would have these live and have these as a hard copy. So hopefully you guys have those pulled up. So here's our 6 steps to financial success. So the first step that we talk about is protecting what you have, then taking control of your cash flow, investing wisely, managing taxes, saving for retirement, and then finally leaving a legacy. And all 6 of these steps have been proven. I've been doing this since 2006, so I've been in the industry for 14 years and have always followed through these 6 steps, even with the different company that I was with, which I was excited when I moved over here 2 years ago to see that we were sort of following the same 6 steps. So let's talk about the first step, which is protecting what you have. So the key areas of insurance, now the term insurance is the transfer of risk. So if you think about like your auto insurance, for example, you're basically transferring the financial risk from yourself to the insurance company if you were to crash your car or somebody was to crash into your car so that they could replace it or fix it. So key areas of insurance coverage that we talk about is medical insurance, long-term care insurance, disability income, which is pretty important, especially here in Oregon, because Oregon does not have a state disability like California and Washington do. Liability insurance, especially if you own a business, property and casualty insurance, and one of the most important ones, I think, is life insurance. Making sure that those things are taken care of as you know, when you do pass. I always joke and say that nobody's going to make it out of this thing alive. So let's talk about health insurance. The health insurance marketplace, you're able to compare private health plans based on coverage options, deductibles, and cost, able to find some answers in coverage, able to enroll in some plans that best meet your needs. But let's be honest, it's really confusing. The insurance, the healthcare.gov website is a little cumbersome, and fairly confusing. And although I'm licensed to be able to sell health insurance, I actually have a health insurance professional, somebody that specializes in it, that I would call them on my team that I refer to and I send people over to, because they're going to better be able to explain it than I will. I understand it on a very surface level, and just don't have the, if I'm going to be honest, the brain capacity to kind of dive into it and get a little bit deeper. So I like to use experts in their field and people that specialize in certain things to help with my clients, with myself even. So life insurance, there's 3 critical questions that we always ask with life insurance. How much do you need? I always say life insurance is like a tool. So I sat down with a couple clients actually this morning, and they're a young couple in their mid-20s, just had a baby, just bought a house. And we talked about, what do they want the life insurance to cover? What do they want it to do? How much in debts do they have between, auto loans, credit cards, personal loans, things like that? How much is their mortgage? How much do they want to pay it off? Do they want to pay part of it off, have just a mortgage payment for a little while? Do they want to send their child to college? If something, God forbid, were to happen to them early when their child was under 18, do they want to use they want to have the ability with the insurance to be able to transfer that financial risk to be able to help their child be able to go to college? And then last but not least, if all that stuff was taken care of, how much money per month does each spouse need to be able to cover life expenses? And for how long? I mean, for me, for example, and for this couple, for example, they wanted to cover $3,000 a month basically for 5 years. So it's just a mathematical calculation on how much coverage they needed. Then the second thing that we talked about was what type of policy they need. So there's 2 basic types of policies. And the first type is what's called a term policy. A term policy covers you for a period of time. It covers you for that 10, 15, or 20, or 30 years that you sort of need that bigger bulk of the coverage. Then there's what's called a permanent policy. A permanent policy is a lot of times referred to as a whole life policy. A whole life policy is a type of a permanent policy, but there's actually 5 different types of permanent policies. So a permanent policy would be something that, for especially for this young couple, they had, they were 25 years old, and now if you insure them right now, it's a lot less expensive to do it than when they're 40 or 45 or 50. So putting a smaller amount in the permanent policy and then allowing that amount to grow would help them out long term, because now 20 or 30 years from now, they'll be able to have the amount of coverage that they need. And then last but not least, who gets the money? Obviously, with husband and wife most of the time, the spouse gets the money. But what happens if something happens to both of them, right? We'll talk about this a little bit when we talk about leaving a legacy. But it's very, very, very important to understand that if anybody has minor children, you cannot leave life insurance proceeds to a minor child. It goes into what's called a conservatorship account, and then they get all the money when they're 18 years old. So when we talk about leaving a legacy and putting together an estate plan, having that so that it dictates how it's put out, how it's distributed. The other thing that I've always said is that I don't want my in-laws or my sister or my brother winning the lottery upon my death. So if I chose a family member that I trust and said, hey, you know what, they would get the proceeds because they would be the one taking care of my children, I don't want them getting a big lump sum of money due to something happening to me. I want them to have enough money to be able to take care of my children, which is actually stipulated inside of my personal estate plan. Group coverages, when we talk about policies, life insurance and disability and long-term care sometimes is available in there. Health insurance may not be fully sufficient. It may not be fully sufficient to cover the things that you need. So having somebody review that is very, very important. By the way, the insurance section is on page 5 of the workbook. If you're looking at the PDF. And then next we're going to talk about taking control of your cash flow, which is actually on page 6 as a workbook for you guys to be able to take notes on. So let's talk about investment in a company. So if we looked at a company, one of my favorite shows to watch is Shark Tank, right? And when they start getting into the numbers, sometimes they do their initial pitch in Shark Tank and the sharks are excited. They're like, man, this is awesome. And then they start getting into the numbers and they go, whoa, wait a second. We didn't really know that. So think about this. Would you invest in a company that had accounting problems that could not account for 20% of its cash flow? So I say this because a lot of times when I sit down with individual clients and families and I go, well, I mean, you just told me that you bring home about $5,000 a month per your expenses that you wrote down. There's only, $4,000 in expenses that you guys had. Where's that other $1,000? They go, I don't know, because they're spending it on things like going out to eat, stopping for coffees, fast food, things like that, right? Regular unexpected expenses. So if there's regular things that happen, there's unexpected charges, hits the capital reserves every 6 months or so, things like that happen. And then routine delays filing statements and tax returns. So would you invest in this company that had all these problems with accounting? I personally probably wouldn't, right? I would want them to fix it before I started investing in that company or purchasing that company or anything like that. So you incorporated. A lot of families, a lot of folks have accounting problems. They cannot account for a significant portion of their discretionary income. I'm going to say a bad word. Budgeting. People don't have a great budget. Well, with budgeting, it's really just telling your money what to do before you do anything with your money. So it's similar to, in my past life, I was a personal trainer. I would use the word dieting, right? Dieting is just planning out what you're going to eat before you eat it. If you're going to eat junk food, plan to eat junk food and then plan to go do the cardio to take that, burn those calories. If you want to go out to eat, if you want to have coffee, if you want to, visit Dutch Bros every once in a while, plan for it. Put it in your budget, right? Regular unexpected expenses. I mean, people forced to liquidate assets in their savings accounts and things like that is a common thing for a lot of families and a common thing for a lot of people. So being able to have that separate emergency fund that is just for those unexpected expenses. Now, I have 2 children. One of them's 1 and he's crazy, and my other one's 4 and he's kind of the wants to follow the rules, pretty cautious with things like that. Unfortunately, my 1-year-old is more like me. He's already trying to jump off the couch and already trying to do some crazy things. So we may have some unexpected expenses with our 1-year-old because he's probably going to hurt himself as he gets older, right? And then routinely delaying filing statements and tax returns. I mean, I know people that file extensions every single year. And in my mind, I just go, well, you're going to owe taxes. At the end of the day, you're going to have to pay it. Why not file early, know what you have to do, and then you could extend the payment, right? You could work with your CPA to extend that payment. So having a plan up front to be able to accomplish that. Some cash management processes, assessing your current financial situation, your current budgeting situation. A lot of times when I sit down with folks, this is probably one of the biggest things that we do is help them budget. Building that cash reserve, having that emergency fund, starting with $1,000. I mean, if you've ever followed the Dave Ramsey methods, he says get to $1,000 and then start paying off the credit cards. Why $1,000? Because most emergencies don't cost more than $1,000. They're $200, $300, $400, $500. And if you don't have to use your credit card to pay for it, you can now attack that credit card debt and get rid of that credit card debt, right? But getting rid of that revolving debt, getting rid of all of that so that you could live a cash life, which is quite nice. And then there's traditional savings vehicles like savings accounts at the bank, certificates of deposit, money market funds, things like that that'll earn you a little bit of interest, that are safe, that aren't going to lose money, that you can get into. Now let's look at the $160,000 credit card. So I talked about credit cards just a second ago. So let's say, just for illustrative purposes, somebody had credit card debt of $30,000. They were paying 18% interest, and it was a $541 a month payment, and they paid on that for 10 years. Well, it's going to take them about 10 years to pay it off by making that payment. They're going to pay about $64,000, almost $65,000 to pay off that $30,000 credit card. Now that seems like a lot. It is, but that's how the credit card companies make money, right? A bank can loan out 10 times what they take in. So if you look at Chase, which is where I personally bank, they could loan out 10 times with credit cards, car loans, mortgages, things like that. So that's how the banks really earn their money, is by charging interest on those credit cards. Now, if you had a stock investment, if you had an investment somewhere, whether it's a mutual fund in the stock market, and you were investing $541 a month, and you were earning 8%, after 10 years, you'd have about $99,000 inside of an account that could be there for you. So for illustrative purposes, this is the difference of $164,500 between the two. Now, I always like to ask people, would you rather have $99,000 or would you rather have paid out $65,000? And the answer is usually pretty obvious. I'd rather have closer to $100,000 than have paid out a whole bunch of money. Question was, is the bank a good place for me to be saving money for my emergency fund? Initially, yes, because it's liquid to you. You can get to it. It's accessible. If you need to get to it quickly, you can. So initially, yes, the bank that you bank at is a good place to be saving for your emergency fund. One of the things that I will add to that is that our personal accounts for my family, we actually bank at Chase. We have another account at Road Credit Union that's an out of sight, out of mind that we keep our emergency fund in. So it's still accessible. We still have access to it. We still have an ATM card to it, but it's not the account or the bank that we do our normal daily transactions or monthly transactions out of. So good question. So moving on to step number 3, investing wisely. So a lot of people ask, hey, what should I invest in? Hey, should I invest in this? The answer usually is, I don't know. And the answer is, I don't know, because we usually have to assess somebody's financial situation before we can kind of figure out where to invest. But today we're going to talk about Mr. and Mrs. Taylor. Mr. and Mrs. Taylor are 50 years old. They have $1 million portfolio in one type of investment. So they're not spread out. They do not protect against investment risk. They've not spread out their risk. And all of a sudden, so let's say this was 2008, they had $1 million, and then by the end of 2009, they were down to half. So 50% of their portfolio went down because they didn't diversify. They didn't have it spread out. So Mr. and Mrs. Taylor learned some lessons. They learned lessons, number 1, to diversify their investments. My mom always said, don't put all your eggs in one basket. Don't count on one thing for everything, right? To spread out some of the expectations and spread out some of the risk. They needed to be able to assess their risk tolerance. If they were getting ready to retire, if they were here and they were getting retired in 5 to 10 years, any good financial advisor, any good financial planner would have started to dial down on the bulk of their money on their risk, because we know the market's going to go up. We know the market's going to go down. So we want to make sure that we're assessing their risk tolerance at least annually and as they get closer to retirement. And then having a managed portfolio, having something where there's a professional, and like I said earlier, having somebody that specializes in it, look at it for you and help you make best decisions for you and your family and what you want to accomplish. There's a few types of pooled investments. Pooled investments may combine stocks, bonds, other securities in one portfolio. There's things called mutual funds, which you've probably heard of, American Funds or Fidelity or Franklin Templeton, companies like that hold mutual funds. And there's ETFs, which are what are called exchange traded funds. Those are still pooled investments. But basically what it is that they take all the risk and they spread it out across a risk tolerance. So if it's a growth fund, it's more of an aggressive one, but they're spreading it out over more companies than just one, versus taking one stock or one company and kind of going for one. I had a client actually call me yesterday, and he was talking about he wants to invest in solar and renewable energy. And he said, what's the best place to do that? He goes, what company should I do? I go, I don't think you should do any company. He goes, well, what do you mean? I go, I think we should pick some type of a pooled investment like an ETF or a mutual fund that sort of has most of their investments in renewable energy. That way they're spreading out the risk. They're doing that stuff. So for a couple of reasons. Number 1, they have more money because everybody's money that's in that pooled investment is now investing in there. So they have more money to be able to purchase some of these equities and purchase some of these bonds at a lower rate because they're buying them in bulk, like at Costco, right? So they're able to get into some of these where we wouldn't be able to as an individual because we don't have billions of dollars yet, right? So why do people invest in mutual funds and ETFs? Well, convenience. It's super simple. So if you look at, I believe that checklist is on page 8 of your PDF. It's convenient. It's easy to get to. It's easy to manage. It's easy to do that. It's professionally managed, which means that there's a lot of times actuaries sitting even beyond the financial professional or financial advisor that's helping you manage it. Plus the financial professional like myself is helping you choose the funds and helping you choose the investments based off your risk tolerance and helping to explain it to you in terms that are very simple to understand. There's a lot of flexibility inside of some pooled investments, and the diversification, really being able to spread out that risk, really being able to take and not, again, have all your eggs in one basket. So types of funds, types of pooled type investments. There's money market funds that are very low risk but very low return. Municipal bond funds, income funds, balance funds, growth and income funds, growth funds, international and global funds, sector funds, aggressive growth funds. Why do I read it like that? Because for most people, all those terms don't mean anything. I mean, it's kind of like if you, my wife's a dental hygienist, and you know, she'll use a term called like SRP. I'm going to do an SRP. I have no idea what that means, right? Most people won't, unless you were in the dental industry. Then you'll understand what that means. So what I'm saying is sitting down with a professional, sitting down with somebody that could help explain these to you and help break them down into very simple terms so that you understand it, so you're comfortable with it, and you can make informed decisions. I've had people tell me no, and it's okay, right? Because I'm helping them to make an informed decision. And I'm not going to put, I have, I mean, my morals and values, but also I have a legal fiduciary responsibility to make sure I'm doing the best thing for my client based off the situation they're in, which takes into account risk tolerance and things like that. So step number 4 is managing your taxes. So if you guys looked at page 9 on your guys' PDF, all taxes are not equal. Most people don't realize this, but 60% of the federal income taxes are paid by the wealthiest 5% of taxpayers. Those are households with over almost a $250,000 adjusted gross income. If you're 1099, you understand what the adjusted gross income means. You understand what that terminology means. But basically, it's the amount of money that you pay taxes on. So 60% of the taxes are actually paid by the top 5% of earners, according to the data from 2019. So let's take a close look at a tax return. So if we looked at your tax return, if we looked at your 1040 and we looked at where it says taxable interest, it says $15,000 on this one. And then we go and we look at, oh, that goes into interest paid. So that's what we call unearned income. So the unearned income gets taxed at a normal income rate. And I always ask, why are you paying taxes on income you're not using? Why not have some tax managed accounts or have it managed properly? And we work very closely with your CPA, if you like your CPA, or we refer you to somebody that we call on our team that we work closely with, that we trust, that could help you and help us figure out how to limit or lessen the amount of taxes that you're paying. But paying extra taxes on interest that you're earning on an annual basis, I give the government enough money from the income that I make. I give the government enough money for some of this stuff. They have investments and they have loopholes. And they have stuff in place that you could take advantage of if you only knew about it. So if we looked at investment taxes, there's 2 types of investment taxes. You have short-term capital gains and you have long-term capital gains. A short-term capital gains is going to be paid as a normal income tax. Long-term capital gains is what I'm showing on here. So if we looked at a single filer up to $40,000, there's no long-term capital gains that have to be paid. But if you make over $40,000 to $441,000, you're going to pay 15%. If you're married filing jointly, you could have up to $80,000, income up to $80,000 at zero, but between $80,000 and $496,000, you're going to have a 15% capital gains. Anything over those amounts, you're going to pay a 20% capital gains. So understanding that as you're investing and as you're doing stuff, by the way, this goes into if you sell a house, this goes into if you have what they call like a 1031 or a DST, if you have some sort of an investment that's in real estate, these are capital gains across the board. This goes into if you sell mutual funds or if you sell some stock positions or if you sell certain things outside of a retirement plan, all this stuff applies. So understanding that to make the best informed decisions for you, again, sitting down with somebody that can help you through that process. So here's some tax favored type of investments. So if we looked at tax exempt investments, the first one we talk about would be municipal bonds. What's a municipal bond? Well, if you understand that a bond means debt, and if you look at stock, it means equity in a company, a municipal bond is just that. It's a municipality like a city or a state that are borrowing money basically from the people. They're issuing bonds and they're giving you, let's say, a 5% yield on that, which just means that the interest that they're paid, just like on your mortgage, just like on your auto debt, they pay interest. So they're paying you interest. That interest income is tax-free. If you buy the bond, say at $1,000 and you sell the bond for $1,500, just for easy numbers, the difference in the two, you may be assessed some capital gains on that. So just so everybody understands. The second tax exempt that we talk about is a Roth IRA. Roth IRA is a retirement vehicle. It has some limitations that as far as income, about how much money you could earn to be able to put money into a Roth IRA. If you're over that income amount, yes, there is a way that you could use a Roth IRA and utilize its benefits. It's just a little bit more of an advanced planning type of a thing that we've been able to help many clients out with. And then there's one that's on here that's tax exempt, that it's pretty confusing how it works, but if you work with somebody that understands it, cash value life insurance could be a tax exempt way for you to save money and earn an interest rate. But if somebody, quite frankly, isn't maxing out their 401k or maxing out their Roth IRA, saving money inside of a life insurance policy usually isn't the best spot for it. So tax deferred, we have traditional IRAs, which means that you put in money generally pre-tax, depending on income again. And then as it grows, and then when you take it out, you get taxed at whatever the income rate is then. Employer-sponsored retirement plans like a 401k, 403b, 457 plan, all those, simple IRA, things like that. Those are all employer-sponsored retirement plans. And then annuities. There's two types of basic annuities. There's what's called a qualified annuity, what's called a non-qualified annuity. A non-qualified annuity is money that you took out of your bank account, you invested it in an annuity. When the money grows after the contract period, or what's called the surrender period, and let's say you put in $100,000 and now there's $100,000 or $110,000 on the non-qualified annuity, you're going to pay an income tax on that $10,000 growth. If we looked at a qualified annuity, that's just a way to protect your qualified money or your IRA money or your 401k money from downturns in the market. And again, working with somebody that understands all of that to be able to explain it to you in the situation is very important. So somebody just asked, how do I know if I should roll over my old employer-sponsored retirement plan to an IRA? Great question. What I usually suggest is that if you're not currently participating in a plan, it's with the company, and it's considered company assets. So if the company did go bankrupt, that money would actually get locked up. If they decided to change plans, there's a freeze period, or what they call a blackout period, that would be held. So always moving your money into something that you're currently participating in, whether it's a current traditional IRA or whether it's going into a 401k at the new job or the new place that you're going to. So let's look at some potential tax savings on some contributions to an IRA, just as an illustrative purpose. So if you contributed $6,000 into an IRA, and I'm going to use a 32% federal tax bracket, you would save about $1,900 in taxes. So that's a pretty big tax savings for, you put some money in. If you're over 50, you get a $1,000 catch up. So you'd be able to put $7,000 in there, and you would save $2,200 in taxes by investing inside of that IRA, because you get to write that money off and lower your taxable income. By the way, these calculations work well for the 401ks and things like that. And like I said earlier, that we work very closely with the CPA to make sure that we're putting the right amount of money in there to get you the tax savings that you need. The way that I look at it is, because I'm 1099, I'm a independent contractor, that if I owe the government $7,000, and I could pay myself $6,000 and owe the government, $5,000, I'm putting a little bit more money away, or changing or adjusting. Maybe it lowers me down into the 24% tax bracket versus being up in the 32. So it helps to offset how much money I'm paying in taxes, but then it's also saving for my future and my family's future for our retirement. So the tax equivalent yield. So what that means is, earlier I talked a little bit about mutual funds, and you're going to get a capital gains tax and things like that. So the tax equivalent yield is just that. If I was in a 32% tax bracket, and let's say I was going to earn 5% in a municipal bond, I would have to earn 7.35% in something that was going to be taxed at a capital gains tax. So it's just understanding the difference and expectations and rate of return that you have to earn. So somebody asked, what is your opinion on loans against your 401k? Great question. And it depends on what the loan is for. If you have the assets in there, and if you're going to use it for something like buying a house or medical expenses, the loan on the 401k generally is or to pay back a private note, right? The loan on the 401k and the loan against the 401k is generally going to cost you less in interest than a credit card or a personal loan from the bank is. And I would just kind of take a look and see what the, as far as the private note, what it was, how much interest you were paying on it versus how much interest you'd be paying back into your 401k. So it's just kind of sitting down and doing an analysis and figuring that out. So we could definitely talk about that. So next step number 5 is saving for retirement. So today we're going to talk about the Smiths, right? Well, the Smiths have enough to retire. So they're 64 years old. They want to retire in about 2 years. They currently live on about $12,000 a month of gross income. They want $9,000 a month in retirement. They have Social Security. They have a couple 401k plans, a little bit of personal savings and some investments. Social Security, they're going to get about $2,700 a month, $2,750 per month if claimed at full retirement, which for them is probably 66 at 8 months. For most of us, or at least myself, it's probably going to be 68 or 69 if I'm going to be honest, because as there's less people paying into Social Security and more people take it from Social Security, they're going to probably extend the age on when we're going to be able to get Social Security. Their 401k plans can safely get them $2,000 per month without them running out of money or giving them the best shot of not running out of money. And they have a portfolio of about $450 a month that could generate about $2,250 per month, which is assuming a 6% rate of return on some investments. And also, they could potentially use an annuity for this to where it could give them a payout of 6% of that $450 for their life. So if we look at it, right, their shortfall becomes $2,000. So all that added up is $7,000. Their goal was $9,000. So what are some ways that we can kind of start to figure that out? Well, some things to take into consideration. Their retirement age. Maybe we extended a year or 2 or 3. Maybe we push that out a little bit. But it's our job, it's my job as a financial professional to help them understand that, hey, you know what, if you just wait 2 more years, if you just wait 1 more year, you're going to get this much more. We'll be able to accomplish this. We'll be able to do this. Their lifestyle. Maybe we talk to them about, changing their lifestyle a little bit. Length of retirement, how long, what's their life expectancy, what does it look like, and then income sources. Are there other places? Can they work part-time? Can they do things on a part-time basis? Can they do an at-home business? Can they do something to kind of generate a little bit more income? One of the things that I like to try to make sure is that they're not going to run out of money. That's one of the biggest things that people are afraid of, is running out of money, is not having enough money for retirement for the longevity of their life. So that does step number 5. Now we're going to talk about leaving a legacy. This is something that's very, very, very important to me and close to my heart. I've helped through my 14 years about 18 families deal with a estate plan or deal with the death of a loved one, between life insurance and helping with death claims and helping get proceeds for retirement plans and things like that. So this is kind of a big deal. So what could stand in your way? Well, let's talk about probate. Probate is a very public court process and proceedings that, my estate attorney jokes and he says, hey, if you don't have an estate plan in place, the government has one for you. So do you want to have it the way you want it, or do you want to have it the way the government's going to do it? Because the government's way is very public. Everybody knows your stuff. They actually have to go seek out debtors or seek out people that you owe money to make sure that you get those debts paid off before any proceeds go to anybody that you love and care about. And by the way, the people that you love and care about through the probate process, they get to fight over whatever assets are there. They get to fight over whatever proceeds are there. Minus, obviously, stuff that has a beneficiary, like a life insurance policy or an annuity or a named beneficiary on a retirement plan. It's kind of hard to fight for that if it's already written down and you've stipulated what it is. And then taxes. What are the taxabilities of your estate? A lot of people don't know that the state of Oregon has a tax exemption of $1 million as far as an estate. Over $1 million, it starts at 10% and then starts to go up. It starts to tier up as you go through it as an estate tax. That doesn't include income taxes. So what does that mean? Well, what it means is that if you have a $1 million life insurance policy and you have a house that's worth $300,000, you're over that estate taxable limit. So your life insurance policy would go income tax free, but it usually gets added to the estate. The other thing that most people don't realize is that when a family member passes away, even if they only earned $1, even if they had one pay cycle through, January 15th, there's still a final income tax return that has to be filed for that person. There's an income tax return that has to be filed with the IRS or with the state that they're in. And then one of the biggest things is long-term care. I am a fan of long-term care. I'm a fan of having insurance for it. Why? Because I would rather have it set up today. I'm 40 years old today. I'd rather have it set up for me today if I have to go into a long-term care facility or if something happens to me personally, versus me having to liquidate all of my assets and then hopefully maybe the government or a family member could help take care of me and do that. I don't want to be a burden on my family. So let's talk about probate. Like I said, it's a very legal proceeding. It's very public. Everybody knows what's going on. They actually publish it in the paper and go and look for it. Generally, and I believe in the state of Oregon, I was on a webinar with an estate planning attorney not that long ago, and I believe in the state of Oregon that I think it was a minimum of 4 months that they have to leave that out there for any debtors to be able to collect any money from the estate. So it's time consuming. So if they get all the debts paid off in 60 days, you still have to wait another 60 days before you can even get to any of the proceeds or any of the assets of that. Like I said, it's not private, right? By the way, if you're a married couple, probate only comes into play if both of you pass away, right? If both parties pass away, not just if one does. If I passed away, my wife would assume everything that I have and assume all of our stuff as her own, and have to make some changes and choices there. So federal estate tax, they take your net value of your estate minus the estate tax exclusion, which currently right now, or as of 2019, was $11.4 million for a married couple, or 5.2 for a single person. In the state of Oregon, like I said, it's only $1 million, so it's not that high. So they equal the value of your state, and then they assess that estate tax and give you a federal estate tax that's due. Now, how do you know how much you owe? Great question. You would have to talk to an estate attorney. You'd have to talk to a CPA or a tax professional that specializes in these estates. And that's one of the reasons why I say we team up with people that specialize in this stuff, because we want to be a resource for our clients and people that we're helping. Long-term care, 70% of 65-year-olds and older will need some sort of long-term care service eventually at some point in their life. My grandfather passed away from dementia. My grandmother on my father's side passed away from Alzheimer's. I've had quite a few concussions racing BMX, doing some of the things I've done in my lifetime. I have a very good potential genetically and from some of the abuse that I've put my body through to probably go into some sort of a mental disorder like Alzheimer's and dementia or something like that, where I might need some long-term care. So having that long-term care service and stuff set up ahead of time to make sure that it's covered financially so you're not a burden on your family is something that's important. And then also with your estate planning, what do you want it to do? What does your healthcare directive say? Do you want to be kept alive on life support if something happened? Those are all important decisions that, again, when I talked about being a burden on my family, I don't want them to have to make those decisions in their time of mourning. I want them to be able to, make those decisions or make those decisions for them when I'm still coherent at it. I had a question: at what age is it optimal to secure a long-term care insurance? Great question. I would say between the age of 50 and 55 is usually the most optimal as far as cost. Generally, and I'll use a general term, prior to 50, it doesn't make sense to pay for the cost of the insurance unless you may think that you may need it. Where might you need it? Where might you need it? Well, if you do crazy things like I used to, where I put my knee on the ground on a motorcycle going 100 miles an hour on my street bike, or race a BMX or things like that, where I may become a paraplegic, I may hurt myself, then maybe some sort of a long-term care type of a policy might be beneficial prior to the age of 50. But generally, it's most cost-effective between 50 and 55, and you're getting closer to potentially needing it. Now, to answer another question that maybe you're thinking about, what happens if I don't use it? Well, there's a couple ways to set up long-term care. You can set it up with a return of premium. So if you don't use it, you pass away, the premium gets given back to your family as a benefit. You could set it up as an acceleration of a benefit with a life insurance policy. So there's a death benefit attached to it. So there's a bunch of different ways to look at long-term care and a bunch of different ways to structure it. And again, it's just sitting down with somebody that understands it at a high level. And this is sort of the arena. Life insurance and long-term care and disability is the arena I started in the industry 14 years ago. So if anybody has any personal questions about it, I would love to be able to have a conversation to figure that out and be able to help you guys out with that. So cost of long-term care across the US, I mean, in New York, it's the highest. I just thought about how in New York on the news it was said that they put people that had COVID in May and April into the long-term care facilities, and looking at the cost of that now and kind of relating to that, I'm going, huh. In Texas, it's a little bit lower, but long-term care is expensive. I have a few friends that have in-care or in-home care services, and I have a friend of mine whose father was in a long-term care facility in California, and it cost him about $120,000 a year. And he got a long-term care policy when he was in his early 60s, the father did. So he had what I would call the Rolls Royce of long-term care policies, because he had it structured properly and put together properly when it was cost effective for him. So some estate distribution techniques, wills are sort of instructions on what you want your money to do or what you want your assets to do. Jointly held property. So if myself and let's say Ellie owned a property together, and it was set up to where when I pass, she gets my half or gets my shares of that property, right? Contracts between business owners, like a buy-sell agreement or something like that, and things like trusts that help run that through. Now, where do you go to get this information? You go to an estate attorney. You go to somebody that specializes in this. Does it cost money? Yes. Is it worth it? Absolutely, 100%. So again, we have people that we've very carefully and very, very diligently done our background and built a relationship with them, and have referred some people to them that and they've done a great job. So we definitely have some referrals and the ability to be able to help people. Some additional estate documents, powers of attorney. What's a power of attorney? It's a document that says that somebody has the ability to be able to take care of everything in my life, my bills, my bank accounts, my investments, things like that. If something were to happen to me and I was incoherent and I couldn't make those decisions for myself. Then there's like durable power of attorneys, medical power of attorneys, making sure that there's somebody there that can get the information from the doctors, number one. And then number two, make the decisions, but make the decisions based off of what I want, not based off of them emotionally making those decisions. Take the emotional decision-making away from the people that I care about and the people that I love the most. And then a living will, right? Having a living will in place, something that you have instructions on what you want to have happen, with your assets, with your home, with life insurance, with all that stuff. Who's going to take care of your kids if you have young children? Having all that stuff in place ahead of time is super important, in my opinion. And then testamentary versus living trust. A testamentary trust will help control distribution. It can help reduce some fees and taxes, but does not avoid probate. So I've seen a lot of clients, and I've had a lot of people approach me about these do-it-yourself systems, these do-it-yourself trusts and things like that. I always equate it back to taxes, or equate it back to buying or selling a home. Can I read a contract? Yes. Do I want a professional if I'm buying a home to make sure the right boxes are checked and all that stuff? Yes. If I'm selling my home, do I want to make sure that I have a real estate agent that is helping me so that my liability is down? Yes, I do. So I can do it myself, right? It's available for me, but I don't want to sell my home by myself. I want to make sure that I have somebody that's checking those boxes. So the do-it-yourself systems, although maybe less expensive on the front end, may be detrimental on the back end to your family. Living trust will help control distribution, can help manage some fees and expenses, and if structured properly, can avoid probate. So who owns my home? Great question. My trust does. Why? Because that's how you're supposed to structure it properly. Who owns my bank accounts? Good question. My trust does. Why? Because that's how you're supposed to structure it properly. How do I know that? Because that's what my attorney told me to do. Right? So I listened to the professional that specializes in that to make sure that stuff was in place properly. How's my business set up? Well, who owns my business, or where does my business go to? My attorney set that up. My attorney did that for me. He checked the boxes because he knows where to go and he knows what to do, right? Now, can I read a contract and probably figure out? Yes. Do I want to take the time to do that, or do I want to trust the professionals that do it for a living? I would rather trust the experts. I would rather trust the professionals that do that for a living. So that gets through our 6 steps of financial success. Any questions that have come up that I haven't answered at all, Marlene?
You've got them all so far.
Awesome. Thank you. So where do we go from here? So you could do it yourself, right? Like I just talked about. all this information, everything with financial planning and financial literacy and all that stuff you could find online. Guess what? You could find all your nutrition stuff and workout stuff online too. I made a great living as a personal trainer because I was able to help them through that process. They could have found all the information on their own, but they would rather trust the expert to do it, right? You could work with somebody else. You could work with another financial advisor. There's some great financial advisors in town. I like to say that we're the best, and not because of rates, not because of like we're going to get you a better rate of return or anything like that. But I just think that here in this office, by the way, I moved from Transamerica Financial Advisors to Oregon Pacific Financial Advisors 2 years ago. Why? Because the office morals and values and character of the company and what it stands for and what we're really looking to do and how we're looking to make an impact on the local community. And then the customer service and the simplicity that we break it down. We don't try to talk over people's heads and talk what I call financial plannerese to people. We really try to help them to understand in terms that people understand. So I would rather people work with us, right? But if you have somebody else you want to work with, I wanted to give the value and give the value at no cost to anybody. And hopefully you guys will refer some people to our webinars as we move forward. Starting next year, we're going to do some very specific webinars for some of the 6 steps that we went through that we're going to have a guest speaker on that is one of the specialists. And then we're going to continue on a monthly basis to do these general webinars. Or you could do what a lot of people do and live in the nation that I call the largest nation in the world, which is procrastination, and keep kicking the can down the road. Quite often I'll sit down with somebody and they'll be 55, 60 years old. And they say, hey, I want to retire at 65. They say, great, how much money do you have saved for retirement? I have $30,000. Okay. So we have to earn 8%. You have to save $5,000 a month to get to your goal. I can't do that. Okay. I want to get this knowledge out to people that are young, to people that to get them in the habit of saving, so that when they're older and they're getting to the point to where they can save more money, they already have that habit in place, so it's not a big deal, right? So helping them learn not to procrastinate. What does it cost for them? Great question. Well, if they attend the webinar, nothing, because we offer a complimentary financial plan for people as we're going through this to help them walk through these steps. We will send you an email if you schedule an appointment. We will send you an email with what to bring. We want to see some tax documents, any statements you have for any investments, life insurances, things like that. We'll send you a very clear document on what to bring. So again, I want to thank you guys for your time. I hope I stayed on time. I did. If anybody has any questions, you can unmute yourself and ask right now. And if not, I hope to hear from a lot of you guys soon. I was glad to see that it's all my friends that are on here. Thank you, Ellie.